Good afternoon, everyone, and welcome back to Bulls, Bears, and the Bell. It's actually our 100th deep dive, so a really big thank you to all of you for tuning in and supporting us over these episodes.
Yeah, 100 episodes. It's fantastic to be here sharing these insights. Thank you all.
Today, we are undertaking a pretty critical deep dive, looking into the financial reports and the market sentiment from October 7th, 2025. Now, this date, it wasn't just another Tuesday. Our sources are really painting it as a pivotal study in contradictions.
That's exactly right. A day where the market was, simultaneously charging forward with this incredible tech euphoria, AI specifically, while at the same time, investors were aggressively hedging against, well, systemic collapse sounds dramatic, but certainly systemic anxiety.
A deeply bifurcated market. The signals are just all over the place, real cross currents.
Totally. Had record index highs, right?
Yeah.
But driven by this really narrow group of tech stocks that screens optimism about the future, about growth, but then you dig just a little deeper and you find investors were spending historic amounts of money insuring against the fragility of the present, particularly the political structure.
Okay, so our mission today for you, our well-informed listener, is to try and synthesize these conflicting narratives. We want to find the actual drivers, figure out the inherent risks, and maybe identify some forward-looking catalysts hidden in this financial paradox.
Let's do it.
All right, let's start with that immediate market snapshot because, like you said, it perfectly captures the conflict. If you just glanced at the headlines, things looked, well, pretty good.
Yeah, on the surface.
The NASDAQ composite, the bellwether for tech and growth, it led the whole day, soared 671%, closed at 22,141.67.
Big number.
And the broader S&P 500 index, also a strong gain, up 0.36%, hitting 6,740.28. These are record highs we're talking about.
Absolutely. The headline narrative just screamed growth, innovation, AI taking over. And this is the crucial bet, the Dow Jones Industrial Average, which, represents a much broader slice of the economy, industrial companies, older economy players. It actually faltered.
Right. It was down 0.14% to 46,694.97. And that actually broke a 6-day winning streak for the Dow.
Exactly. And that's the first critical takeaway for you listening.
Yeah.
The momentum that was powering those headline numbers, it was incredibly concentrated. It was masking this underlying weakness, this anxiety across the majority of the economic landscape.
So it was a rally based more on hope for tomorrow, not necessarily strength today.
Precisely. Built on a few key pillars.
And that narrow focus, those pillars, brings us straight to the core paradox of October 7th. You have money pouring into these highly speculative, high-growth tech futures, driving stocks to records, at the exact same time that you see this significant, truly historic flight into safe haven assets.
It's wild, isn't it? The simultaneous embrace of this, technologically driven future while aggressively insuring against the immediate fragility of the political and financial present. It's like betting on a rocket ship while buying flood insurance for your house.
That's a great way to put it.
And that dual movement, that's what makes this moment so interesting, maybe even historically significant. It suggests investors aren't just, rotating capital between growth and value like they usually do.
No, it feels different.
It feels like they're deploying capital into two completely separate, almost opposing belief systems. On one hand, they totally believe in the unbounded exponential growth promised by artificial intelligence.
The bull case.
The roaring bull case. But on the other hand, they deeply fear the stability of fiat currencies, of government operations. And that's driving gold and Bitcoin into absolutely unprecedented territory.
It's like an intellectual split, right? The bulls are roaring for AI, but the bears are hedging the entire system.
Exactly. Hedging the system itself.
Okay, let's focus first on that roaring bull side then, the AI catalyst. Because the sheer momentum we saw in tech, particularly in semiconductors, it was fundamentally tied to the fallout from that landmark strategic alliance announced just a bit earlier in the week.
Yeah, we're talking about the formal tie-up between Advanced Micro Devices, AMD, and OpenAI. This was huge news.
AMD was already on fire, right? It surged something like 24% the day before. On Monday, just on the initial news.
A massive jump. And then on Tuesday, the day we're focusing on, the stock kept climbing, added another, 3.6 to 4.8%. Pretty significant follow-through.
And this wasn't just like momentum chasing, was it? This felt like the market really cementing AMD's position.
Absolutely. Cementing its position as a legitimate challenger to NVIDIA in this really high-stakes AI hardware race. This was validation.
So the specifics of the deal mechanics, I think that's where the confidence really gets underscored. Our sources confirmed OpenAI isn't just signing some purchase order.
No, no. They're committing to using AMD chips for a core part of their foundational AI infrastructure. That's a big commitment from a leading player.
But the most interesting detail, I thought, was the reported potential 10% equity stake OpenAI is getting in AMD through warrants.
Right, the warrants. That is a highly strategic commitment, and maybe we should unpack what that means for listeners. A warrant, essentially, it gives OpenAI the right, but crucially, not the obligation to buy a big chunk of AMD stock at a set price down the road.
So ties their futures together.
Exactly. It's not just cash changing hands.
Hmm.
For OpenAI, it creates this long-term economic alignment with their chip supplier. If AMD succeeds wildly in the AI chip market, OpenAI profits directly from that success through the stock appreciation.
And for AMD.
For AMD, it's this huge vote of confidence from a major AI customer. It signals extreme confidence to the entire industry, validates their technology. It's basically an incentive structure designed for shared long-term success. Really smart.
And that one alliance, that AMD OpenAI deal, it created ripple effects, didn't it? Boosting the whole semiconductor and enterprise AI ecosystem.
Oh, absolutely.
Yeah.
It extended far beyond just those two companies. You saw the PHLX semiconductor index, the SOX index. It maintained its positive momentum after jumping nearly 3% on Monday.
And seeing the SOX index track that high, that's important, right? It signals broad confidence.
It really does. It suggests confidence across the entire supply chain, not just the headliners like AMD or NVIDIA. It implies that the foundries making the chips, the memory providers, the companies making peripheral components, they all anticipate a sustained surge in demand.
So the market believes the AI boom is structural, not just a temporary cycle.
That's the implication when the whole supply chain moves together like that, yes.
And we saw that translate into specific gains for companies actually building the AI infrastructure. Dell Technologies, for instance.
Yeah.
Their shares rose, between 3.7 and 5%. That's a solid move for a company that size.
And it was driven by clear, fundamental demand signals. Dell actually increased its long-term revenue forecasts, and they explicitly cited robust demand for its AI-optimized servers.
Because the AI models need somewhere to live.
Exactly. Companies like Dell are manufacturing these premium, likely high-margin servers required to house them. They're providing the physical backbone for this whole digital revolution that everyone's talking about.
IBM also got a piece of the action. They gained 1.7 to 3%. That was tied to a partnership with Anthropic, right?
Yeah, integrating the Claude AI chatbot, which is, a major competitor to OpenAI's models, integrating that directly into IBM's core software products.
And that seems crucial, too. It's like the second phase of AI adoption.
It really is. It shows companies aren't just buying the chips anymore. They're now actively integrating these large language models directly into their business processes, into their customer service tools, their internal workflows. It confirms this widespread enterprise appetite for actually using these advanced models to drive real productivity gains.
Okay, so the enthusiasm is, well, it's palpable. You can feel it. But the underlying financial reality, it seems like it's already starting to inject a note of caution, doesn't it? Even within this euphoric sector.
Yes, and this is the necessary counterpoint. You always need that reality check. Being an AI player, even a big one, doesn't automatically guarantee immediate, easy profits. We saw Oracle's shares fall 2.3% on Tuesday.
And that was following reports indicating they were realizing pretty thin profit margins on their AI cloud business.
Exactly. Specifically on the business of renting out NVIDIA's super powerful high-demand chips.
Ah, so even if you have the hot commodity, renting it out isn't necessarily a gold mine?
It raises a really important fundamental question. If the cloud providers, who are essentially the landlords in this scenario, renting out the computational power, their margins are getting compressed already.
Then what does that say about the overall model?
Right. How sustainable is the overall capital expenditure model? AI requires massive capex up front. We're talking billions spent on chips, on data centers, on cooling infrastructure. And the market seems to be realizing now that the return on that investment, the ROI, it might be slower and maybe thinner than everyone initially projected in the hype phase.
It's a profit margin issue hiding inside a growth story.
Perfectly put.
And even NVIDIA itself, the established king of the AI hardware hill, its stock actually declined over 1% on Monday. That suggests investors are getting maybe a bit more discerning.
I think that's exactly it. More discerning. It's no longer enough to just sprinkle the words artificial intelligence in your press release and watch the stock pop.
Right.
Investors are moving past the initial headline excitement. They're starting to ask the harder questions about cash flow, about cost structures, about the realistic timeline for profitability. It's a natural, necessary evolution for any major emerging technology.
So the insight here for you listening is crucial. That massive capital spending required for AI, it's starting to raise some significant ROI questions. And that could definitely temper future enthusiasm if these margin concerns keep popping up.
Absolutely. Something to watch very closely.
Okay, let's pivot now. From that technological euphoria, let's turn to the epicenter of the systemic anxiety we mentioned, the political impasse in Washington. The U.S. government shutdown was entering its second week around October 7th. That's the long shadow looming over everything else.
And it was creating tangible, painful consequences. The disruption was moving rapidly from just, abstract political theater
Right, cable news fodder.
into concrete, real-world economic harm. We started seeing reports of staffing shortages at the FAA, causing widespread delays at major airports.
And that's not just an inconvenience for people trying to get somewhere.
Not at all. It directly impacts global logistics. It messes up shipping schedules. It reduces the velocity of commerce. It costs businesses real money every single hour that backlog persists.
But the most critical consequence, at least for the financial markets, was the government data blackout.
Oh, absolutely critical.
Yeah.
The market relies on government agencies releasing vital official economic data. Things like the monthly non-farm payrolls, the big jobs report for September was due around then, consumer sentiment figures,
Yeah.
key inflation readings like CPI or PCE. All of that stuff was delayed or just completely absent.
And the absence of that data, it forces everyone, the Federal Reserve, big institutional investors, analysts like us, to operate with severely reduced visibility, as our sources put it.
It's exactly like flying an airplane into a storm, but your radar's suddenly gone dark. You know conditions are probably bad, but you can't accurately gauge the severity. You can't see what's directly ahead. And that opacity, that lack of clarity, it just breeds uncertainty.
And uncertainty is toxic for asset prices, usually.
Usually.
Yeah.
But this is where the market got truly bizarre, really counterintuitive. The shutdown, which is objectively a deeply negative event for the economy and for confidence,
Right.
it was actually fueling market optimism in a weird way. How does a government failing to operate possibly translate into a stock market rally?
It feels like backwards logic.
It is backwards logic. It's the paradox of the data vacuum. Because the official, high-quality government statistics weren't coming out, it dramatically amplified the importance of weaker, often less reliable private sector signals.
So when the government goes silent,
Something like Wednesday's unexpected contraction in the ADP private sector jobs report,
yeah,
which, most analysts consider a less robust indicator than the official government payrolls report,
yeah.
it suddenly gains this outsized influence.
Okay. So because the market couldn't see the whole accurate picture from the government.
It overreacted massively to one negative data point it could see, even if it wasn't the best data point.
Got it.
And that single week data point showing a softening labor market, it immediately emboldened calls for the Fed to ease rates. Traders jumped to the conclusion, the economy is slowing rapidly. The Fed has to step in and cut rates now.
But that conclusion wasn't based on a comprehensive view of the economy. It was based on one single, potentially noisy, private signal that got artificially magnified by the shutdown.
Exactly. Artificially magnified.
And we could see this reflected immediately in the hard data, in the market pricing for future Fed actions, right? The probabilities for rate cuts just surged.
The surge was dramatic. You saw the market pricing in a 97% likelihood for a 25 basis point cut at the Fed's October meeting, and an 86% probability was priced in for another cut in December.
Wow, 97% for October.
To put that in context, just a few weeks earlier, the market was still debating the timing of maybe the first cut, maybe sometime next year. Suddenly, because of this data blackout and 1 week private report, the market became almost certain of 2 cuts before the end of this year.
Okay, but let's challenge that a bit. If the market is reacting this strongly to potentially weak data in a vacuum, shouldn't the Fed be worried? What if they signal a rate cut based on this, and then the government reopens, releases the official jobs report, and it turns out to be strong? Wouldn't that make the Fed look, well, irresponsible?
That is the crucial question. That's the inherent risk baked into this artificial rally. The market is rallying purely on monetary easing expectations.
Hopes.
Hopes, exactly. Expectations that are being artificially reinforced by the economic uncertainty their shutdown itself created. It's a feedback loop built on missing information.
So if that political impasse in Washington gets resolved quickly, say next week,
And then robust official data gets released, maybe showing a resilient economy, perhaps even one that's still a bit inflationary, well, those dovish rate cut expectations would unwind incredibly abruptly.
and that abrupt reversal would hit stock prices instantly, especially those rate-sensitive tech stocks that were leading the rally.
Precisely. It highlights how this rally was really built on a foundation of wishful thinking and informational darkness. Very fragile.
That deep-seated anxiety about the political system, the data blackout, the potential fragility, it brings us directly to this fascinating counterpoint, this major shift we saw happening in the cross-asset landscape. When investors lose faith in the political structure and the flow of official information, they execute what our sources called a systemic hedge.
Yes, and this is perhaps the most compelling story of the week for me, because it completely contradicts that AI euphoria we were just talking about. This
Yeah.
wasn't just portfolio rotation. This was a massive, truly historic flight to assets perceived as being fundamentally outside the traditional fiat currency and political system.
Let's start with the classic safe haven, gold. We witnessed a genuinely landmark moment on October 7th.
Unbelievable, really. Gold surged past the $4,000 per ounce threshold for the very first time in history. Now, COMEX futures settled slightly below that, around $3,976.30, I believe.
Right.
But the breach of that $4K milestone, even intraday, is hugely significant psychologically and historically, obviously.
Well, what was driving that surge? Was it just the shutdown?
It was a powerful confluence of drivers, really. First, yes, the immediate political instability from the shutdown was a clear catalyst. People get nervous, they buy gold.
Sure.
Second, there are these growing longer-term concerns about the sheer size of sovereign debt globally, not just in the U.S., and the associated risk that brings of sustained, hard-to-control inflation down the line.
And third,
Third, the anticipation of Fed easing. If the Fed starts cutting rates, that reduces the opportunity cost of holding gold, which famously yields nothing. So gold becomes relatively more attractive compared to interest-bearing assets like bonds when rates are expected to fall.
so gold is basically flashing this major warning signal about multiple things at once.
It really is. Robert Kaplan, former head of the Dallas Fed, now at Goldman Sachs, he called gold's appreciation, which was nearly 40% year-to-date at that point. He called it a red light that we ought to be paying attention to.
A red light. That's strong language from a former Fed president.
It signals that inflation risk is definitely not priced out of the market, despite the rate cut hopes, and that political risk is escalating significantly.
And you also had Ray Dalio, founder of Bridgewater, the world's largest hedge fund, weighing in.
Right. Dalio, who's long been an advocate for holding hard assets, was recommending investors hold as much as 15% of their portfolios in gold. These aren't just casual endorsements,
Oh.
These are serious warnings from incredibly experienced market players who are actively hedging against the potential long-term devaluation of traditional fiat currencies.
Okay, now let's look at the parallel story, which is maybe even more surprising in some ways. Bitcoin's rally.
Yes. In a highly unusual move, Bitcoin surged right alongside gold. It hit a new all-time high, broke decisively above $125,000, and even touched $126,000 intraday.
And the key thing is, it did so in lockstep with gold.
That simultaneous rally is what really defies conventional market correlations. Historically, gold is your pure risk-off asset. You buy it when you're scared, seeking safety. Bitcoin, on the other hand, has always been characterized as high risk, high beta, highly speculative.
The ultimate risk on asset, some would say.
Exactly. So for them to rise together strongly on the same day, it suggests that investors are starting to view Bitcoin through a new, perhaps more fundamental lens.
So connecting this to the bigger picture, this isn't just investors hedging against a potential stock market downturn, is it? Because usually they'd buy bonds for that. This feels deeper.
Absolutely deeper. The dual rally in gold and Bitcoin signals a broader, more profound hedge against fiat currency risk and sovereign risk.
Meaning risk related to governments and their debts.
Precisely. Both gold and Bitcoin are decentralized, non-sovereign assets. Their value isn't directly controlled by any single government or central bank. So investors seem to be hedging against the very stability of the entire monetary and political system. They're seeking stores of value that, in theory, cannot be devalued by massive government spending or inflationary central bank policies.
It's like a crisis of confidence in the system itself.
That's what it looks like. And it breaks that old model where you had to choose. safety in gold, or speculation in Bitcoin. Now, it seems, for some investors at least, both are seen as hedges against the same central threat, the potential instability of the established financial order. Hashtag tag double IPV, sentiment check, and technical warnings.
Okay, so with the market hitting these euphoric record highs, particularly in tech, but also seeing this profound anxiety driving gold and Bitcoin, we have to ask the critical question. Is this rally actually healthy? Is it sustainable?
Yeah, let's pop the hood and check the internal plumbing. See what the technical indicators and the market structure itself are signaling.
What's the message?
The message from the market's internals seems pretty clear. Extreme caution is warranted. Lizanne Saunders, among others, I think summarized the environment perfectly. She noted the market was exhibiting clear signs of frothiness, and critically, that the rally's foundation was exceptionally narrow.
Exceptionally narrow, meaning those record highs we talked about in the NASDAQ, they were being propped up by just a handful of stocks.
A surprisingly small, elite cohort. We have specific data points to really underline this concentration risk. Get this, only 4 out of the so-called Magnificent 7 big tech stocks were actually outperforming the S&P 500 year-to-date at that point.
Only 4 out of 7. Wow.
And despite all the incredible AI hype surrounding NVIDIA, the absolute darling of the sector, it only ranked 45th among all S&P 500 constituents in terms of year-to-date gains.
45th? That's surprising. So the gains were even narrower than just the Mag 7.
Exactly. That concentration poses a really serious structural risk for you, the listener. The broad market, the average stock, is struggling, yet the indices are being held aloft by just a few mega-cap names.
Which means if those few key leaders reverse course, maybe due to profit-taking, maybe some negative news specific to them,
they could exert a disproportionate, just massive drag on the entire market structure. It's like a beautiful house built on only, 4 very expensive pillars. If one cracks,
the whole thing could wobble. Okay, now, let's look at investor sentiment, maybe complacency. You'd think with a government shutdown, sovereign debt fears bubbling near record highs, investors would be scrambling for portfolio insurance, right? Buying puts.
you would absolutely expect that. But the volatility indicators suggest the exact opposite was happening. Deep complacency.
How so?
Well, look at the VIX, the CBOE Volatility Index, often called the market's fear gauge. It was trading below 17.
And the historic average is around 20, isn't it?
Exactly. So below 17 is notably low, means very low demand for portfolio insurance, signaling investors just weren't worried. Furthermore, the put-call ratio was also low.
Meaning more people were betting on prices going up, buying calls, than betting on prices going down, buying puts.
Significantly more, bullish bets were far outpacing bearish bets.
So it's like the market is driving this high-performance race car at top speed, maybe on slick tires given the risks, but almost nobody bothered to buy crash insurance or install a safety net?
That's a fantastic analogy. We're running without adequate portfolio insurance, collectively. Saunders captured the sentiment well again, noting that with such sluggish hedging activity, if a negative catalyst does hit the market, most market participants are lined up on one side of the teeter-totter. And when that teeter-totter inevitably falls, the lack of bearish positioning, the lack of hedges, means the decline can be incredibly swift, brutal, and probably exaggerated by forced liquidations as people scramble to get out.
Not a pretty picture. And finally, what about traditional technical warnings? Were they flashing anything?
Flashing bright red, actually. The key momentum indicator, the Relative Strength Index, or RSI, was suggesting a correction was highly possible, if not overdue.
How does that work?
Well, both the NASDAQ composite and the broader NYSE composite were trading with an RSI above 70. Now, for those unfamiliar, an RSI reading above 70 is the classic technical signal that an asset, or an index in this case, is considered overbought.
Meaning it's gone up too far too fast.
Eventually, yes. It doesn't guarantee a fall is imminent, but it strongly suggests the pace of the recent ascent has been too rapid. It implies a pool of willing buyers might be getting exhausted at these levels.
So in that kind of overbought environment, even a minor piece of negative news
can trigger aggressive profit-taking and potentially a sharp downward correction, simply because the underlying technical momentum is stretched thin and unsustainable. The market becomes very vulnerable to bad news. Hashtag Texas6, spotlight on court movers and shakers.
Okay, well, that big macro picture was dominated by these huge contradictory signals, AI hype versus systemic fear. The corporate spotlight actually provided the single most dramatic individual stock story of the day. We absolutely need to dissect the spectacular case of Trilogy Metals, ticker TMQ.
Oh, the Trilogy Metal story. That was a true outlier, absolutely wild, and potentially maybe a harbinger of a whole new valuation paradigm for certain types of companies.
What happened exactly? The numbers were staggering.
Their shares surged over 200% on the day. They closed somewhere near the $6.57 range, I think. But after hitting an intraday high of $7.90, and the volume was just explosive. Options volume was running something like 265 times its typical daily level.
265 times normal. That's insane. That's not just market fluctuation. That's a fundamental, instantaneous re-rating of a company.
Exactly, a re-rating.
So what was the catalyst? It wasn't like they struck a massive new copper deposit or beat earnings by a mile, was it?
No, the catalyst was pure, unadulterated U.S. industrial policy, straight from Washington. The U.S. government announced a direct strategic investment of $35.6 million for a 10% equity stake in Trilogy Metals.
The government is taking a stake.
Yeah.
Why?
The purpose was explicit: to support critical mineral exploration up in Alaska's Ambler mining district, specifically to secure the domestic supply chain for minerals vital to national security and the energy transition. And crucially, this investment came alongside an executive order aimed at clearing the path for the vital Ambler Road infrastructure project, which is needed to actually transport the materials out of that remote region.
Okay, so this is what makes the TMQ surge such a landmark event, isn't it? It completely redefined the company's intrinsic value, basically overriding traditional financial metrics.
Precisely. The market suddenly started valuing Trilogy Metals, not just on the geological potential of its deposits, which include copper, cobalt, gallium, and germanium, all critical for defense, next-gen tech, clean energy,
Right.
but valuing it as a quasi-sovereign strategic asset. Because the company is now directly backed by the U.S. government, its mission is aligned with securing domestic supply chains against geopolitical risk, reducing dependency on foreign, potentially adversarial sources.
So this might be the birth of what some are calling the national security premium in stock valuation.
I think that's exactly what it is. Investors are now actively looking for other companies, maybe in rare earth elements, advanced battery technology, perhaps even certain types of critical software companies that might become targets for similar strategic government intervention or support. And that potential fundamentally changes the valuation floor for those companies.
It introduces a completely new investment thesis. When government policy directly backs a company's future, especially against geopolitical risk, that policy guarantee can override traditional factors like quarterly profits or operational costs. It leads to this kind of explosive fundamental re-rating.
It really suggests that value, going forward, might increasingly be defined by strategic national importance, not just simple supply and demand economics. A huge shift to consider.
Definitely something for you listening to think about. Okay, moving away from the drama of TMQ, we did have some other notable corporate movers on October 7th. Constellation Brands, STZ, the beverage company.
Yeah, they had a nice gain, somewhere between 0.6 and 3.4%. That came after they successfully beat both earnings and revenue expectations, although management did acknowledge they're operating in a challenging socioeconomic environment.
Seems like everyone is acknowledging that these days.
On the losing side, yeah, Tesla.
Tesla. The highly anticipated unveiling of their supposedly low-cost Model Y. Well, it apparently failed to meet the market's sky-high pre-announcement hype. The stock sank 3.9%.
So investors had baked in something revolutionary, and it didn't quite deliver.
Seems like it. They expected maybe more significant cost-cutting breakthroughs than what was announced. The hype exceeded the reality, and the stock paid the price.
We also saw the home builders take a hit. D.R. Horton, KB Home, Toll Brothers, they fell about 1 to 2%. Yeah, that followed a ratings downgrade from Evercore ISI. They expressed skepticism, not necessarily about current sales figures, but more about the outlook for future meaningful demand. Their argument was basically that slightly improved affordability wasn't enough to overcome the headwinds of still high interest rates and broader consumer caution.
Makes sense. And then there was massive volatility in a company called Strive Inc., ticker AST.
Right. Strive saw its stock decline sharply, something like 13 to 16%. That seemed due to a combination of just extreme underlying volatility and also news of an investigation by the law firm Brodsky and Smith regarding its recent, somewhat controversial merger.
The one where they repositioned the company as a Bitcoin treasury company.
Exactly. So you had investor uncertainty about the whole corporate structure, the viability of that strategy, plus the inherent volatility of Bitcoin itself. It all created a strong downdraft for the stock that day.
Okay, and finally, we should definitely note an important after-hours earnings highlight. Penguin Solutions, PENG, an enterprise AI company.
Yes. Penguin Solutions came out after the bell and absolutely crushed expectations. They reported non-GAAP earnings per share of $0.43. The consensus estimate was only $0.22.
Why? Nearly double the consensus.
Yeah, a huge beat. And on top of that, they authorized a new $75 million stock repurchase program, signaling confidence in their own share value and future cash flows.
So that's the kind of performance that really validates the underlying AI thesis, right? It shows that some players in the space are indeed executing successfully and generating significant cash flow, despite those margin concerns we talked about earlier with Oracle.
Absolutely. That Penguin result certainly provided a powerful, positive signal that likely helped keep that semiconductor and AI optimism alive heading into Wednesday's trading session. A much-needed dose of positive fundamentals amidst the hype. #TAG7, the economic and earnings horizon.
All right, let's move towards the economic horizon now. Let's quickly review the limited economic data we did manage to get on Tuesday, October 7th, despite the shutdown, because it really presented a challenging mixed signs of slowing activity, but also rising consumer anxiety about inflation.
Yeah, it was a bit of a muddle. We definitely saw signs of economic cooling in the logistics sector. That's often a good real-time indicator of commerce velocity. The LMI, the Logistics Managers Index, it fell to 57.4 from 59.3 the previous month.
Now, a reading above 50 still means expansion, right?
Correct. It still indicates expansion in the logistics sector, but the rate of expansion is slowing down. That suggests some cooling in the broader supply chain, maybe in inventory management activity. Things are still growing, but not as fast.
Okay, but at the same time, we saw inflation expectations actually ticking up.
Right. The New York Fed's monthly consumer survey showed that consumers' median one-year-ahead inflation expectations crept up to 3.4% from 3.2% the month before.
So the economy might be cooling slightly, but people are expecting prices to rise faster in the near future. That's not a great combination.
It's absolutely not. That's the precise, challenging scenario that gets economists worried about stagflation-light slowing growth combined with stubbornly rising inflation expectations. And that makes the Federal Reserve's job exponentially more difficult. Which way do you lean?
Exactly. But the most jarring piece of data that day, the one that really signaled potential consumer retrenchment, was the consumer credit change number.
Oh yeah, that one was a real shocker. Consumer credit outstanding, it slowed dramatically. It increased by a mere $0.36 billion. That's billion with a B.
And the consensus estimate, what economists were expecting, was an increase of $13.5 billion.
Missing consensus by nearly $13 billion.
Sure.
That is not just consumers being a little cautious with their spending. That's a seismic shift in borrowing behavior.
What are the implications of a miss that huge?
It's a really clear signal of profound consumer caution, maybe even stress. People are simply not taking on or relying on credit cards, auto loans, etc., at anywhere near the expected pace. If credit growth missed by that much, it fundamentally alters the outlook for future retail sales, for holiday spending, particularly for companies that rely on discretionary purchases, often fueled by borrowing.
It suggests that high interest rates, maybe combined with general economic uncertainty from the shutdown and everything else, are finally causing the average household to pull back really aggressively on taking on new debt.
Which strongly foreshadows slower consumption growth ahead, a big warning sign for the economy.
Okay, what about the bond market? In fixed income, the 10-year Treasury yield was relatively stable that day, wasn't it? Hovering around 4.13 to 4.16%.
Yeah, pretty stable. And despite all the background noise, the concerns about U.S. sovereign debt levels, the political chaos of the shutdown, the actual demand for government bonds, seemed to remain pretty solid.
How could we tell?
Well, we saw confirmation of that solidity in the 3-year Treasury note auction held that day. It's stopped through by 0.8 basis points.
Stop through. What does that mean?
Stopping through means the final average yield that the Treasury accepted for the debt was slightly lower than the yield that was implied by market trading just before the auction results were announced. It essentially means the actual demand from bidders at the auction was stronger than the market had anticipated.
So even with all the debt concerns, people were still eager to lend money to the U.S. government at those prevailing rates.
It suggests the appetite was still there, yes. At least for shorter duration debt, like the 3-year note.
Okay, looking ahead from that Tuesday, there were 2 extremely high-impact potential catalysts coming up later that week. Events that would likely define the market's direction, especially given that government data vacuum we keep talking about.
Absolutely critical events. First up, on Wednesday at 2:80 Euro p.m. Eastern, was the release of the FOMC meeting minutes from the Fed's previous policy meeting.
And why are the minutes so important, especially now?
Because, with the lack of fresh official economic data, the minutes offer the most detailed, unfiltered look available into the internal debate happening among Fed officials. We'd get insights into their thinking on inflation, on growth, on the future path for interest rates. You'd be looking for clues on how worried the Fed really was about the potential economic slowdown and, crucially, whether that dovish shift the market was pricing in was a unified view within the committee or if it was maybe more contested.
Got it. So reading the tea leaves from their internal debate, and then the really big one. Thursday morning, 8:30 a.m. Eastern, Fed Chair Jerome Powell was scheduled to give a speech.
The highest impact event of the week, for sure. His remarks were set to be intensely scrutinized. Again, because of the data drought, his commentary would carry significantly magnified weight.
Every word parsed.
Every inflection, every nuance. Investors would be hanging on his every word, searching for signals on monetary policy. Specifically, they'd be listening for whether he validated, pushed back against, or ignored the market's aggressive pricing of 2 rate cuts by year-end.
And any deviation from that current dovish expectation, say, if he sounded more worried about inflation than the market thought,
could trigger a substantial immediate repricing across all asset classes, especially given those overbought technical conditions and the one-sided positioning we discussed. Powell held the key to whether the fragile rally continued or collapsed.
We should also quickly note the on-deck earnings that were due before Wednesday's market open. McCormick and Company, the spice maker.
Right, MKC, a crucial indicator of consumer staples health and also what inflationary cost pressures they might be passing on.
And also Village Supermarket, VLGEA.
Yeah, another data point on consumer spending habits, particularly around food price inflation. Both would feed directly into those concerns about rising consumer inflation expectations we saw in the NY Fed survey. #Tag8, conclusion and forward thought.
Okay, let's try and bring this deep dive to a close now with our final synthesis, October 7th, 2025. It really feels like the embodiment of the paradox we started with. The market was truly, as you said, balanced on a knife's edge.
Yeah, driven simultaneously by this narrow, almost explosive AI enthusiasm on one side.
And this broad, deep-seated anxiety about monetary stability, political stability, the whole system on the other.
The market's next big move really seemed to hinge entirely on which of those powerful contradictory forces would gain the upper hand. Would the sheer promise of technological transformation overcome the macroeconomic fear? Or would the systemic anxieties around the shutdown, around sovereign risk, finally puncture that narrow tech-led rally?
So, looking forward from that day, what were the immediate things investors and you listening needed to monitor for the rest of that week?
I think 3 key things. First, you absolutely had to see follow-through buying in AMD and the broader semiconductor sector. If that leadership started to falter, the momentum behind the entire NASDAQ rally was seriously threatened.
Okay, tech leadership.
Second, you needed clarity or ideally some kind of resolution regarding the government shutdown in Washington. Continued impasse meant continued data blackout and uncertainty. A resolution could bring back data, potentially challenge the rate cut narrative.
And third, obviously.
Third, intensely scrutinize Fed Chair Powell's monetary policy signals on Thursday. His tone, his message, would likely dictate the market's direction for perhaps the rest of the quarter. Those 3 factors were paramount.
All right. And as always, we like to leave you with a provocative thought, something to mull over, building on our discussion. Today, it really has to stem from that landmark trilogy metals story.
Yeah, it was something else.
The market's valuation models are clearly, visibly shifting. We saw TMQ get explosively repriced, not based on traditional earnings or cash flow metrics, but based on a direct government stake and its role in securing a domestic strategic asset.
A national security imperative trumped standard financials.
Exactly. So the provocative thought for you to consider is this. What other non-traditional factors, things like national security needs, maybe climate change imperatives forcing certain investments, perhaps other forms of strategic political intervention? What other factors like these will create the next national security premium? How might they fundamentally change the way value is defined in the specific sectors you follow or invest in?
It's a crucial question. The rules of the market, increasingly driven by these geopolitical fault lines and overarching policy risks, seem to be changing faster than many traditional balance sheets or valuation models can easily account for.
It's a compelling new element of both risk and opportunity that every investor really needs to start integrating into their thinking, into their analysis.
Couldn't agree more. Lots to chew on there.
Indeed. Well, that's all the time we have for today's deep dive. Thank you again for joining us for our 100th episode of Bulls, Bears, and the Bell. We'll see you next time.